Two undervalued stocks to consider in April of 2024. This is a series that I do every month, trying to find two undervalued stocks, and it's not easy whenever you have the S&P 500 sitting pretty close to all-time record high. But I did promise you guys I'm going to do my best to find these stocks, and I did find two stocks that I'm going to share in the video. The first one is a little bit safer, recession-resistant kind of stock, compounder over the very long term. The second one is much riskier, but it's sitting at 2 times earnings, and there's way too many catalysts for the stock to move up, but it's much riskier. But I decided to share both of them here in the video. Now, the first stock I'm going to talk about, which a lot of people really don't like, and it's mainly T-Mobile. Most of you are familiar with T-Mobile. T-Mobile competes with AT&T, Verizon, Comcast, many other players in the United States in terms of internet, data, 5G, and many of other services that a lot of the telecom actually provides. It's up 13.5% over the past year. Now, if you compare T-Mobile to AT&T and Verizon, T-Mobile is up 132% over the last year versus AT&T and Verizon down 28% and 29%. And this is why a lot of people don't like T-Mobile, because they own AT&T or Verizon. And I'm a big fan of AT&T and Verizon. I did say these stocks were a buy back in, I think, October or December. And since then, AT&T has done well, and Verizon hasn't been too bad. So both of them have started to do well. I'm a big fan of them. But T-Mobile is doing something right. And this is why it has outperformed. And I think it will continue to outperform. I'm going to tell you why in the video. Now, the first one, which is a diminishing advantage, and this is T-Mobile's advantage in many of the fast providers, and T-Mobile does have much faster internet in terms of download and upload versus AT&T and Verizon. But where the advantage was, but it's again diminishing, is mainly in 5G, because Verizon is catching up, AT&T is going to eventually catch up, which is a diminishing advantage, of course, but it's still so far the leader in 5G. In terms of the latest earnings report, they did do pretty well, in my opinion. I'm going to talk about guidance, but also in terms of total customers did increase. Total high-speed internet customers also increased. T-Mobile has so far been doing well, but in terms of the main argument on why you shouldn't buy T-Mobile, this is the main one. And people say, why would you buy T-Mobile? It's sitting at 17.5 times earnings for a telecom. This is extremely expensive. Verizon is trading at 8 times earnings, and AT&T is trading around 8.5 times earnings. So why would you buy T-Mobile for 17.5 times when you could buy Verizon for 9 and AT&T for 8 times? It just doesn't make sense. But if you compare the growth of T-Mobile versus AT&T and Verizon, it's a huge difference. I mean, if you look from 2023 as an example, T-Mobile earnings per share growth, it grew 13%. AT&T grew around negative 6%, didn't even grow. Verizon, negative 9%. Now, both of these companies did have an improvement in free cash flow, but in terms of per share metrics, they still did not do well. Same thing is expected in 2024, 22% growth for T-Mobile. Even free cash flow growth is high. Verizon is not the best. AT&T is not the best, 2025. So over the long term, T-Mobile has been growing faster than Verizon and AT&T, and I would expect this growth to continue. And this is why T-Mobile is much more expensive than AT&T and Verizon. In terms of the outlook is pretty amazing, in my opinion, for 2024. They have around 16.3 to 16.9 billion of free cash flow, and this will put the company around an 8.6% free cash flow yield. So you have an 8.6% free cash flow yield for a company that is still growing free cash flow amazingly well, and it's still growing earnings per share 20 to 25% now, and it's going to continue doing it over the long term. And the best part about it is that T-Mobile is not all in on paying a dividend. They also do buybacks. So if the stock does go down, this is good news, because T-Mobile can eliminate shares from the market. They do have some debt, but nothing crazy as something like AT&T and Verizon. So I believe T-Mobile has been so far much better managed. And I'm just seeing good metrics in general. I'm seeing good management, good performance. I'm seeing earnings per share 20 to 25% growth over the long term. And I'm seeing a company trading at an 8.6% free cash flow yield for such growth in free cash flow and in earnings per share. I think T-Mobile is reasonably valued, and it's maybe a little bit more on the undervalued side compared to many different opportunities. And it's a recession-resistant stock. So if we do have a recession, people will likely continue paying their internet bills, their phone bills, and many other things. And yes, T-Mobile is trading at a much higher level than it was before. But I think the move is largely justified because fundamentals have improved so much, and they will likely continue improving. So even though T-Mobile is much more expensive than AT&T and Verizon, I think T-Mobile here is a buy. I would expect around 15, 16, over 15% annual return as long as they keep the earnings per share and free cash flow growth. And I believe they will continue doing that as they already made the CapEx investments and many different things that they wanted to make. So now they can pull back on CapEx, which will increase free cash flow, and they can use it to do buybacks, which is much more powerful than dividends, in my opinion. So I think T-Mobile is undervalued, even though it's sitting at all-time high. And this was the first stock for the video, T-Mobile. The second one is a little bit crazier stock. Maybe a lot of you are not gonna like it, but this is a stock called DAC. DAC is a shipping stock, of course, but it's not your typical shipping stock. If you look at it over the last 5 years, DAC is up 503%. Most of these stocks are extremely cyclical. If you look at ZIM, Integrated Shipping, which was a huge stock for retail investors, everyone was long ZIM, and it was a very kind of stock that people really liked. And DAC actually is the one that spun off ZIM, and they did sell all their ZIM shares, I believe. So they don't own any more of the ZIM stock. They collected the dividend and sold their shares last year before the massive crash, or the year before. So DAC has been doing well over the last 5 years because DAC is a little bit different than ZIM, and it's a little bit different than many of the other shipping stocks. And if you look at it, it's sitting at 2.5 times earnings. Now, whenever you see a stock sitting at 2.5 times earnings, 99% chance that this stock is a value trap, because there's no way. Why would it be sitting at 2.5 times earnings? This is normally because the company or the stock is cyclical, meaning it's based off some kind of a commodity price. So for example, a lot of the gold miners or a lot of the lithium miners, you would see lithium miners like ALB, let's say at 5 times earnings. You say, oh, 5 times earnings is cheap. Maybe it was cheap based off a much, much higher lithium price. And now the lithium price is lower. Therefore, it's not really trading at 5 times earnings. Maybe it's trading at 10 or 15 times earnings. But this is what makes DAC different from other shippers, is that DAC tries to lock in contracts for the long term. For example, they have $2.3 billion contracts through 2028. A lot of these contracts were locked in at peak freight rate prices in 2021 and in 2022, especially in 2021. They did lock them in. So they have visibility in revenues within locked in contracts. So it's not as vulnerable as the short-term shipping rates as ZIM actually was. And this is what makes DAC different from ZIM and different from many of the other shipping stocks. So they have visibility. We can try to calculate what kind of free cash flows they could get. But for 2024, for example, the revenue is expected to be very close to 2023. 2025 will go down a little bit. 2026 to 2028 will likely average out around 800 million, which is close to 2023 and 2024. And I believe the 2025 revenue will eventually pick up as we go into 2024. The contracts expire, and then they renew the contracts for a few years. So I believe they will most likely experience an uptick in revenues, and it will end up being the same as 2023 and 2024. But to illustrate in this video, I'm only going to take the 2024 revenues, which they have visibility for, because they locked it in at a long-term contract. And before I get into it, I'm just going to talk about the debt situation a little bit. It's amazing for DAC. They had 2.7 billion of debt. Now it's only 382 million. And the debt profile is amazing in terms of maturities. They have no major maturities before 2028. So they have a lot of flexibility before 2028 to use the free cash flow to either buy back stock or issue dividends. And the company does buy back stock. It's not like ZIM. ZIM could not buy back stock because it was based in Israel. And Israel, they had laws where they cannot really buy back stock unless they apply for something. So this is why ZIM had massive, massive dividends. But DAC can buy back stock if the stock does go down. And this is what I'm going to use for my calculation of DAC. Also, it's extremely hard to calculate. But as we talked about in terms of the revenues, in 2024, it will likely be pretty close to what it was in 2023. Now, in 2023, the free cash flow was 308 million. So I would assume the free cash flow should be 308 million for 2024. But a lot of the analysts, they disagree. They see 186 million, or pretty close, let's say, to 200 million of free cash flow in 2024, maybe because of higher CapEx. I know they're trying to sell some ships and replace them and expand the fleet a little bit. So maybe this is why. So to be safe, I'm going to use just a basic 200 million free cash flow number for 2024. and we talked about them having, or DAC having some liquidity. They have around 609 million of liquidity, but in terms of cash and cash equivalent, they have $272 million. And we add the 200 million of free cash flow from 2024, which we have visibility for through locked-in contracts. We have around $480 million of cash inflows in 2024. Now, $480 million for a $1.4 billion market cap, this is pretty close to 35% of the market cap is going to be generated in 2024. 35%. So ZIM or DAC can use this money and buy back a massive amount of the market cap. They can issue dividends. They could do so many things. They could pay off the debt and increase enterprise value or lower enterprise value, which was lowered largely, as you can see in this chart. It was massive and it went down as they repaid the debt. So they have a lot of liquidity to do whatever. And not just in terms of a cash position, but in terms of credit facilities and credit, stuff and many others, they have 609 million of liquidity. So in real, they have around $800 million of liquidity. They can use it to buy back stock if the stock goes down, which should put a floor on the stock somewhat. And they also could pay dividends. They could do so many things on 1.4 billion of market cap. So this is why I believe DAC is extremely, extremely undervalued at this price. The 2 times earnings, I think, is real or pretty close to being real because it's visible revenues within contracts all the way through 2028. And this is the best part about DAC. They focus on longer term contracts than shorter term contracts. I've never owned them. I was never a big fan of it, but I did own DAC many times. I've been in and out of the stock. I don't personally think it's a long-term investment, even though it has done amazingly well. But you have a stock that's undervalued. They can buy back stock. They can get 35% of the market cap in cash next year in 2024. And maybe it could end up being a little bit more. And they have visibility through long-term contracts. And they also have a lot of potential tailwinds, which I hope nothing happens. But anything on the geopolitical side, anything that could affect supply chain, maybe another bridge, something happens with some bridge or something happens. I hope nothing happens. But if something does happen, this is another catalyst that could mess up supply chains. And if you have easing all around the world, and if you have the Fed or other places cutting rates or expanding monetary policy, then this is going to even increase economic activity, which is eventually going to put some pressures on supply chain. And this is bullish for DAC. Anything that could mess up the supply chains is bullish for DAC. Now, the last thing I want to talk about is mainly the CEO, which he owns 47% of the company. And a lot of smart people have been highlighting it as a risk for a while, but it's been since pretty much 3 or 4 years. He's been selling some stock here and there, and the company was able to buy back stock. They were able to issue dividends. They were able to do everything, but I just have to mention it, that the CEO owns 47% of the company. Now, I have to admit, the DAC is the riskiest one, but it has the most upside potential, so you have to know what you're doing. If you want to invest in DAC, you don't just buy in dollar cost average. If the stock is going down 50, 70, 80%, you have to know when to get in, when to get out, when to do certain things. But for me, if I had to buy DAC, I would not hold it beyond 2024, but I would just hold it and see what happens. And this was just my opinion on these 2 stocks. It was not financial advice. Thank you for watching the video. I hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.